For those of you that have been following along with all of the segments, you will know that a couple of weeks ago, I embarked on a bit of a journey where I started to introduce how I do cash flow using financial foreplay. And what I mean by that is I use storytelling, I use visuals, and I also use our characters, Penny and Ernest, to start to teach cash flow without actually going back to the numbers and showing people in a numerical sense, how that they would figure out to do cash flow. So why did I do that? I did that because there are a lot of misconceptions out there about cash flow, but here's what I learned through this process. I got an inordinate amount of great emails from people writing in and saying the following. People are saying, our listeners are saying that they really benefited from having a visual picture of what cash flow looks like. I also got a lot of really great comments from people about the segment that I did on chronic poverty mindset and showing that often the lack of cash flow is not just tied to a financial illiteracy issue. It can be tied to any number of things, including just the way that you've been brought up, the values that you have around money, what you were taught by your parents when you were young, whether you might have some things like scarcity mindset or some challenges around being penny wise and pound foolish. All this stuff is really, really important. And I was really encouraged to get so many positive messages from everybody about what they learned from the cash flow episodes. But surprisingly, something strange happened, which perhaps I shouldn't be so surprised at hearing this because I often do encounter it when I'm speaking in person and teaching cash flow to people face to face, is that I noticed one glaring problem. And that problem was simply this. There are again, still some misconceptions around some of the terminology. And what I am noticing and finding is that there are still people out there, listeners out there, who may be confusing the terms working capital and cash flow. So what I'm going to do before we move forward and get into some of the more in-depth and advanced areas of cash flow, I want to come back and I want to specifically address this issue of working capital. And I want to come back to basics and make sure that everybody is on the same page and that everyone's clear about where we're going with this and what is the difference between working capital and cash flow. So this entire segment is going to be dedicated towards that, but I promise it's still going to be tons of fun. So what I want to do first of all is I want everyone to get out a piece of paper and a pen. And I want you to just write two words down on your piece of paper. And one of them is the word required, and the other one is the word available. And I promise that if you can just remember these two words, you're going to always have an easy and simple way to distinguish clearly between what's working capital and what is cash flow. And hopefully this will be something that you can take with you and you can also teach it to somebody else. So cash flow is a very large thing. Cash flow is all encompassing. And the word available really encapsulates this. So whenever you think of cash flow, I want you to use or remember the word available. And remember that it just means simply this. Your cash flow is all of the cash that you have available to pay all of the bills in your business. And cash flow includes everything. It includes everything from your fixed expenses, things like your rent and your wages, all the way through to the stock that you might buy if you sell products, or perhaps the money that you have to spend if you sell services to hire people to do the work and those sorts of things. So cash flow is the big daddy, right? It's about all of the cash that you have available in your business to pay all of the bills that are out there. Now, working capital is something slightly different. Working capital is a smaller subset of cash flow in that working capital is essentially the amount of cash that is required to pay or to get you through your operating or your working cycle. And all that is, it's just the overall number of days that it takes from when you use cash. So you use your own money to either purchase stock, for those of you that sell products, or to pay for the labor and materials to create your services, to when you actually secure the sale and you collect the money from your customer, right? So that those total number of days is your working cycle. So working capital doesn't include things like paying for your rent and all that sort of stuff. It's just the amount of cash that you need to have on hand in your business at any given time to fund that operating cycle, to fund those, total number of days that it takes you from when you take the money out of your bank account, use it to pay for stuff that you're going to sell, and then when you actually sell it, and then finally collect it from your customer. So I just want you to always think of it in those terms. And I promise you that if you can remember the two words available and required, you are never going to go astray. You're never going to go wrong. And always to remember that working capital is a smaller subset of what the total cash flow is. And oftentimes when people are running businesses, here's the thing. It's one thing for me when I'm working with business owners to coach somebody through cash flow issues. So someone's got a cash flow issue. We need to figure out what are the key drivers behind that issue. And we can often try to figure out what are the strategies to work our way through to improve our cash flow, to get more money in the bank account, that sort of thing. But sometimes when you're dealing with working capital issues, there's always going to be a need for working capital. And so what ends up happening in your business is that as your business grows, if you need a certain amount of working capital to fund the operating cycle, as the business grows, so do your working capital requirements. And that's okay, because given what the requirements are for your business, you're going to need more working capital as you grow. It's not a sign of weakness. It's a sign of this is what it takes to actually fund the cycle in your business. And unless we can reduce that number by working on certain strategies and tactics, we're going to constantly need to help you find more capital so that you can grow. And oftentimes what I find happens a lot of times in coaching and in business is that people can sometimes grow themselves into going under. And that's just because they're not managing their cash flow and or their working capital requirements very well. So I wanted to spend some time, now that we're all clear about the difference between working capital and cash flow, I just wanted to spend some time talking about what I think are, some of the best ways to source working capital for your business. So working capital is oftentimes, as we have discovered, a difficult concept for a lot of people to grasp, right? By definition, working capital is just the amount by which your current assets exceed your current liabilities, right? And some people calculate it a number of different ways. I've seen people say current assets minus current liabilities, and that will give you a number. Hopefully it's a positive number because you have more assets than you have liabilities, meaning the amount of money that you owe other people. It can also be calculated as current assets divided by current liabilities, and that gives you a slightly different type of a number. But again, we're looking for situations where hopefully your business has more assets than you have liabilities. However, if you simply, run one of these calculations a month, it doesn't matter which one of those, what's going to happen is you're not going to accomplish much in the way of highlighting, what's going on with your working capital needs, or more importantly, how are you going to meet them, right? It's just a number that you calculated. Lots of software packages will do it. It's not hard, but the problem isn't, can you calculate it? Can you diagnose it? The problem is, do you know how to fix it? So I want to talk about some stuff that I think could be helpful to you. A more useful measurement tool for determining your working capital needs is something that is called an operating cycle or working capital cycle. And some people will call it your cash conversion cycle, or they might even call it your cash gap. So if you've heard your accountant use any of those terminologies, then you now know what he or she is talking about. It's a lot more practical than just, adding and subtracting a couple numbers in a couple of ways, right? Because once you know what the number is, so once you know how long your operating cycle is, it's easier for you to set targets, and you can use the number to help identify whether you have enough working capital to sustain your business growth next month or next quarter, whatever. Your operating cycle is also going to measure your amounts of accounts receivable, your amounts of inventory, your work in progress, and your accounts payable cycle in terms of days. And so it comes down to a simple formula. And just so that you know, I am going to present some of this stuff in visual format in the show notes. So if you want to take a look at what this looks like from a visual perspective, you can follow along with me there as well. It simply comes down to this formula, right? Debtor days plus your inventory days or your work in progress days minus the days to pay your creditors. Now, the visual example is just could be something as simple as this. How you can have a look at the show notes. You might have 60 days on average where you have stock sitting in your business. You're going to be adding the amount of debtor days, and your debtor days is just, how long you let people, your customers, get away without paying you. Let's just say in our example, that's 40. So 60 plus 40 is 100, right? Now we're going to minus to come up with our operating cycle, the number of days on average it takes for you to pay your suppliers. And if in our example, that number is 30, 100 minus 30 gives you 70. So that just lets you know that your cash conversion cycle, your cash gap, your working capital cycle is 70 days. Clear as mud, right? Hopefully I haven't lost anybody. Now, let's break it down a bit more so that you can get some insights that you can use to make this a little bit easier for you to operate comfortably with enough working capital each month. And I also want to explain to you what all of this means in plain language, right? Because I don't want you to be focusing so much on calculating this stuff because it can easily be done through lots of different apps and packages that are out there. But I want you to have a general understanding for what all this stuff means. When your accountant or maybe you've got a coach or advisor wants to have a look at your operating or your cash conversion cycle, essentially what they're looking at, and I've said this before, is just the overall number of days it takes from when you use your hard-earned cash to purchase stock or to pay for the labor and materials to create the products or services that you're about to sell to when you actually secure that sale and collect the cash from your customer. That's it. That's what that 70 days that we just, hypothetically talked about really means. It basically just means that you're out of pocket for 70 whole days in your business, which is quite a long time if you think about it. It's more than 2 months of cash. Now, this is, for those of you that have an operating cycle that may be, somewhere in the order of 60 or 70 days, what that essentially means is that you need to have enough cash sitting in your bank account or maybe in a form of a line of credit or some other means to actually fund the operation of your business while you're, waiting to collect that cash. And 70 days is a long time, but it just essentially tells you how long you're out of pocket, the money's gone out of your business, but none of it's come back in yet. And knowing this metric is really crucial in putting a value on how much working capital you need to sustain you during the period when you're, waiting to make and collect the money for your sales. The longer the period is in days, guess what? The more working capital that you will require. And if your working capital is a large amount, meaning it's more than 60 days, guess what? As your business grows, your requirement for working capital will also grow because usually when your business is growing, the working capital cycle is not coming down. It's usually staying relatively constant unless you're taking specific action to fix it. Now, to calculate your operating cycle or your cash conversion cycle or your cash gap, whatever you want to call it, you have to first assess and calculate how many days on average it takes you to collect an account, right? To collect your money, to turn inventory or work in progress into sales, and to pay your supplier invoices. And I don't want you to focus too much right now on doing that stuff because, as I said, it can easily be done using software and apps and stuff that are out there. More importantly, I want you to step back for a moment with me and just think for a moment how you might apply this knowledge to your business, right? Rather than focus on the math behind all these calculations, let's just take a step back together. I want to share with you the thought process behind why we're doing this exercise and what it actually means for you and your business. Now remember, you don't need to know how to manually calculate this stuff because you can use apps and software to automatically do it. However, it is really important that you understand why this number is valuable and how you're going to use it to make better decisions, right? To ask better questions, make better decisions about operating your business this month and into the future. Now, unfortunately, most businesses can't finance their working capital requirements, you know, their goods, that time, the invoice collection, all that stuff each month, which with accounts payable financing alone, right? So it's almost impossible, usually when you're running a business, to get so much credit from all of your suppliers that you're able to fund the working capital requirements solely in house without anything. I know the only company that I know of in the world that does that fairly successfully is Amazon. I don't know if any of you guys know this, but it's kind of a fairly, well known fact that Amazon, when they started out, they made quite a few changes, and some of the changes that they made along the way drastically helped their working capital and helped them. It helped them in this way. Amazon is well known for taking months and months to pay their suppliers. And because they have negotiated such long payment terms with all of the people that they need to pay, guess what? It drastically cuts down their operating cycle, because the number of days that they take to pay their suppliers has been reported upwards of, 60 to 90 days. They basically use that capital to run their business. And because they did that, they required very little financing from the bank and also from owners. So here's the thing. I want you to remember that you don't need to know all of the semantics, but you do need to know that likely, unless you have amazing terms with all of your suppliers, you're probably going to need to find a little bit of finance here. Let's talk about how you might do that. The shortfall in cash for a number of days, which is your operating cycle or your cash conversion cycle, gives rise to the need for working capital financing, and it's typically covered by the net profit in your business, borrowed funds, or by a combination of the two. And when I say borrowed funds, that includes, money that you might get from the bank, or money that you might actually put in either yourself or by other investors. So there's a couple of different ways that you can make up your working capital. Almost every single business needs short-term working capital at some point. However, most businesses don't calculate or understand that they need it, which means that they're continually on the back foot reacting to the pressure of inadequate working capital. And I see this happening so much in business. If you are able to correctly measure and quantify the specific need that you have for your working capital, you're going to be at a much, greater advantage. You're going to have a distinct advantage this year over what happened to you last year, because two things. You're going to be proactive, and you can address your need to fund or find additional working capital ahead of time. Or number two, you can set targets and you can communicate them with your team. And that means that everybody's collectively working towards lowering your operating cycle, right? Because a lower number of days is always going to be better, because it means you're out of pocket for a less amount of time. And therefore, you're going to have a lower need for working capital. So it's really important to know your working capital, because you want to make better decisions. And the only way that you can do that is by setting targets and having every single person in the team knowing, which way that you're rowing the boat. And the second part of it is you just want to be, proactively addressing your need for working capital. If you're in high growth, guess what? You're going to need more. So if you're in retail, I'm guessing that, not all of you will be, but bear with me with this analogy. If you're in retail, you're going to know how hard it is to fund, seasonal inventory build up between September and November in preparation for Christmas sales. A lot of retailers, not all of them, but a lot of retailers have very high sales during the Christmas period, right? So the same is also true for businesses like pool cleaning or landscaping or lawn mowing, because they do the lion's share of their trade during the summer months, right? So the business is seasonal. But even businesses that are not, traditionally seasonal occasionally experience peak or quiet months. Now, in addition to the normal operating cycle, which is, just the amount of time that you're out of pocket waiting for sales to be collected, seasonality can also increase your need for working capital to fund your inventory or your work in progress. And accounts receivable can easily build up, right? Unfortunately, sometimes it's easy when you're making sales to focus on the sales and not spend enough time focusing on collecting the money from the customers. So, unfortunately, most small businesses are undercapitalized. I see this time and time again. Small businesses often get started and they, right from the very beginning, don't have enough money in the bank to fund the operating cycle. So a lot of businesses are undercapitalized and they simply just don't have enough cash reserves to fund seasonal working capital needs. Now, if your business is currently in need for some short-term working capital, there are several potential sources that you can look to for that sort of funding. The most important factor is, of course, to know that you have a working capital problem, right? And also, you have to be able to quantify it. So if you don't know, you could easily get caught off guard and you could put the future of your business in jeopardy. So it's really important to know that you've got the working capital problem specifically. And which is, as we now know, differentiated from just, thinking it's cash flow in general. It's really important to know that it's tied to the number of days that you're out of pocket waiting for people to pay you, right? And it's also important to know this because it's easier to find the right solutions, viable solutions to working capital problems if you have a clear handle on what the magnitude of the problem is. So I want to give you the 5 most common sources of short-term working capital financing and just kind of talk you through them quickly. The first one is equity. If you're a startup or you're not yet profitable, then equity funds may be your only alternative to covering short-term working capital needs. And these funds can be injected by you, they can be injected by a family member, a friend, an angel, or even another investor. But here's the thing, and I've said this time and time again, equity is a really important source of working capital. But if you're looking for other people to give you money, one thing that you want to keep in mind is you want to be able to show them. People are more likely to give you money and give you money on favorable terms if you can prove that you have, to this point, managed your own money or the other money that you have right now wisely. So I just want you to keep that in your, back of your mind, because a lot of people lament about the fact that, it's very, very difficult for them to get equity financing. But the truth of the matter is this: people are unlikely to give you money or part with their money injected into your business if they think that in the past you have not managed your own money wisely. So that's just kind of a bit of a, truth bomb there. The second that I want to talk about is creditors, right? If you have developed a strong relationship with your trade creditors, you may be able to negotiate better terms, maybe a one-off thing or better terms on an ongoing basis, which will improve your working capital situation immensely. If you have a history of paying on time and your creditors are going to be much more likely or much more willing to extend terms to you, especially if it means that you can place a bigger order with them, right? So it's about your value to them as a customer. Your creditors may ask to take, a charge or a lien over the goods as security until you pay, but that in many cases will be a small price to pay if it enables you to continue trading and it helps you to actually manage your working capital cycle. If someone's come to you and they said they want to place a huge order, but you cannot do it because you don't have working capital, then creditor financing may be one very simple way to facilitate that sale and make sure that you don't lose it because you simply can't afford to buy that stock or produce that service. The next thing, number 3, is invoice financing, which is very, very popular. You see so many fintechs actually popping up in this space now offering invoice financing. It used to be that you pretty much had to go to a bank to do factoring or something, but that's not the case anymore. There are a lot more options. What if you could use the funds that are tied up in your receivables to grow? That's essentially invoice financing. Many Australian-owned companies that are very popular, you've heard of them, Waddle, the Moolah exist, there's On Deck, there are many. And many of these are actually global players, and you'll see them in the American and the UK and overseas markets. They offer a sort of modern invoice financing type solution. They offer options that kind of resemble in a way a perpetual line of credit, even though it isn't such, but similar, to how a bank or an overdraft might work. Many of these will allow you to draw down and pay back, which is very similar to what you see with typical working capital loans, so that you can pay your bills and that you can continually fund the growth strategy over time, or perhaps even just use it as a safety net during some quiet trading periods. You can draw down and repay these funds, just paying interest only on the balance. And even some of them are quite clever in that they integrate seamlessly with your cloud accounting packages, and which is fantastic because it sure makes the reconciliation of the drawdowns and the interest payments and all that stuff much more easy to do than it used to be in the past when you needed to do it manually. So I highly recommend these to you if you happen to be a business that has a working capital deficiency and you have large numbers of dollars tied up in customer accounts that have yet to be paid. The fourth one that I want to talk about is just a simple line of credit. You know, everybody probably is pretty familiar with this, but the trickier part is actually getting it, right? Lines of credit are extremely helpful, but they're not extended to new businesses by most traditional banks. You know, if you have a strong trading history and sufficient collateral, you may be much more likely to qualify for one of these loans from your bank. A line of credit is typically only extended when a business needs to borrow funds for short-term needs, and banks will often put terms or restrictions in place to ensure that the funds are only used for short-term needs. Thankfully, that there are a lot of fintechs now that are playing in this space, which have, you know, drastically opened up quite a few different possibilities for small businesses who need lines of credit and cannot qualify for traditional bank lines of credit. The only corollary to all of this is that the interest rate will be much higher. Whereas a bank line of credit right now might be running between sort of, I don't know, 8 to 9 or 10%, depending on what your trading terms are and whether there are guarantees in place. If you want to look at fintechs providing these lines of credit, you are probably looking at interest rates in the order of 22 to 29%, which is very, very similar to what you might see on a traditional credit card. So these lines of credit are available. However, if you are having to pay those sorts of inordinate high interest terms, you want to be working your pricing in whatever you're selling to make sure that you are getting enough from your customers to cover the additional costs that you may have to pay on these lines of credit. So this is less true for bank financing because usually the rates are much lower. And then the final method or, you know, common source of traditional working capital is, of course, short-term loans. You know, and that's just plain and simple going to the bank. If you can't qualify for a line of credit or what you're asking for the money for is less than of a short-term sort of need, you may still be able to obtain a short-term loan from a bank, a non-bank, or a peer-to-peer lender. Now, depending on your situation, they may or may not require that you also put up security for these types of things. So it's really important to know kind of what your options are. Your strongest options are always going to be equity because you have the most control over when you pay those sources back, because they are not usually requiring you to pay them back in a short-term capacity. Oftentimes, you know, because it's equity, they're investing in the company and they're expecting to get returns as the company grows over time. But there are obviously great benefits to having equity and not having debt because you're not having to pay for it on an ongoing basis. It's part of your company. So if you're looking for a quick way to measure your working capital, please reach out. I'm happy to answer any questions that you have about this sort of stuff because they can easily be done online. There's plenty of apps and ways to do it. But more importantly, I want you to have a really clear understanding of why working capital and cash flow are not the same thing. They're not the same thing at all. Cash flow is a much more larger and comprehensive number, and it includes all the cash that you need available in your company to pay everything down. Whereas working capital is much more focused. It's all about just simply the amount of time that you're out of pocket from when you pay the money out to produce the products or services that you're about to sell to those customers and the time that you make those sales and collect those sales. Now, it's really, really important that working capital is differentiated from cash flow, but it's equally important that you know two things, right? We talked about these: the magnitude, so how much working capital you actually need in your business, and then number two, where you might go about getting it. There are a number of different places right now that you can find working capital. Some of them are cheaper, and obviously some of them are more expensive than others. However, the good news is that there are lots of different ways that you can bring the working capital into your business. And depending on how long you've been in business and how many customers and suppliers you have in your business, you actually have the other options as well that we talked about. So I'm glad that we regrouped and actually came back and talked about this working capital concept, because I didn't want to go further knowing that there might be listeners out there who are a little bit confused about those terms, because in previous episodes I have cleared up some conceptions about cash flow forecasting, as well as talking about the difference between forecasting, which is uncertain, and cash flow, which is 100% of a certainty as well. So hopefully we've cleared up a few conceptions, and I look forward to getting your questions if you have any about working capital. We're going to be doing a little bit of a diversion, because the next couple of episodes we're going to be taking on sorry, Kane, I just want to go back and regroup and redo again. In the next couple of episodes, we're going to be talking a little bit about what some of the implications might be for firms that have less working capital than they need to actually keep going, and how firms are traveling now, companies are traveling now that we're coming out of the COVID period, and some of the protections that might have been in place to keep companies afloat, to keep them out of bankruptcy and out of liquidation, how that landscape is changing and what that might mean for your business. So now that we've got a little bit of a better handle on working capital and cash flow, we're going to be talking about what happens if you're not able to fix those, and what some of your options might be going forward. So hoping all is well, and I look forward to receiving all of your feedback and questions that you have about working capital. Have a great day. Bye-bye.